What's up, folks? Kenneth here, 100 Years of Wealth, streamhomeloan.com. Go ahead, like and subscribe. Question being posed here: how do you refinance? How do you refinance your home loan? Why would you refinance your home loan? But basic question: how do you refinance? So, as you know, if you've watched some of my other videos, I am a mortgage professional. I am a mortgage broker as well as a correspondent lender. And I've been doing this for a very long time. What is a refinance? How do you refinance? Why would you refinance? Every homeowner should understand this concept. And it applies to auto financing as well, or any other sort of loan that you might take out. There usually is an ability to refinance. What refinance means is that you already have an existing loan at a certain set of terms, and then you're going to basically take out a new loan to pay that loan off at new terms. So obviously the only reason why you would refinance would be to create some sort of a benefit in comparison from your current situation to the transaction that you plan on going into. So the most common reason someone would refinance would be to lower their interest rate. When it comes to home loan financing, usually when someone gets into a home loan nowadays, they are putting a minimal amount down. They're usually putting down 3.5%. Some scenarios are putting down 3%. Sometimes they're putting down 5%. If you have a little bit more money in the bank, you might put down 10%, 15%, 20%. But I would say most buyers that I've dealt with over the last few years are putting down the smaller amounts, 3.5%, 5% down as an actual down payment. So what happens is when you finance that much of the purchase price of a property, your terms aren't going to be as favorable as they would be if you were to put down a larger amount. If you were to put down 20%, you're going to get much better interest rate and costs associated to your loan than if you were to put down 5% or the 3.5% scenario. And depending on if you go with a conventional loan versus an FHA loan, there's going to be different financing costs related to different transactions. So the basic concept is that when you get into a loan at, let's say, less favorable terms, because maybe you bought the house and you just put down a minimal amount, that's usually going to indicate that you would have a higher interest rate than if you had more equity in the property. So as time goes, after you enter into your initial loan getting into the property, you will pay your balance down with each monthly payment. If your loan is a principal and interest monthly payment, which usually when you first buy a house, your loans are going to be your traditional 30-year fixed loan, and a portion of your payment is going to go towards principal, therefore lowering the balance, while another portion goes towards interest. So if you're paying principal and interest, that means each month your balance is going down on the property or on the loan that you owe. And usually, depending on the market, of course, depending on where you're at, usually you're going to see a slight increase in your property value as time goes on. Some areas the increase is faster than others. Some areas you might have a stagnant real estate market where the values just kind of remain steady and you're not really seeing that increase in property value. But either one of those scenarios, you're going to be creating a gap or a space in between what you owe and what the property's worth. Even if the property value stayed the same, your balance should be steadily decreasing, creating equity. Unless you're, unless you're in a declining market, which can happen as well. But overall, property values the last 100 years, the last 50 years have steadily, increased over time. So the concept when refinancing is that, the most basic benefit would be refinancing for rate and term, meaning that you have a scenario where I bought this house, I put down 3.5%, let's say I got a 5% interest rate. Fast forward a year, I've paid the balance down a little bit, maybe I've done some home improvements, increasing the home's value. Now, instead of being at 95% like I was when I bought the home, I've increased the value and paid down the balance. Maybe I am at 85% loan to value. So therefore, for a lender, they look at that in a more favorable risk scenario, because I there's a bigger space between what I owe and what the house is worth. I have more equity. So for a lender, if I go to them, unless the rates have jumped up, or depending on what the rates are, because we're always in a rate driven or a market driven environment in real estate and mortgages, it's always going to be rate driven. But assuming rates are relatively the same, possibly got a little bit better, I'm going to go back to this lender and say, hey, it's been 6 months, it's been a year, I've paid my balance down and my property value has increased, my credit has, let's say, stayed the same. So for that lender, they should be able to say, hey, you know what, our algorithm, our pricing matrix tells us that now this is a lower risk scenario because of the fact that you have increased your equity through home improvements or through paying down the balance or just appreciation in the area. That should offer more favorable terms for that client. So in that scenario, if the rates have roughly stayed the same, they should be able to get a better loan in some way, shape, or form, right? And it's always going to depend on the market. So if rates have ticked up a little bit, but you have a little bit of a better, loan to value, maybe it doesn't really make enough sense at that time to refinance just for rate and term. Maybe you're able to say, okay, hey, you know what? Rates are roughly the same, so it's not really going to create a massive difference on my monthly payment, but maybe I'm able to take out a little bit of cash. I've gained, $50,000 in equity. Maybe I want to refinance and take out $10,000 of that equity and pay off a debt or use it for some sort of home improvement. So that's another benefit that you could, have in a refinance transaction that isn't necessarily rate driven. But when you do get a loan and you're only putting down 5% or 3.5%, you're going to have what's called private mortgage insurance. Private mortgage insurance for conventional, or mortgage insurance premium for FHA, effectively the same thing, but that's an increase to your monthly expense for the fact that you bought a home and only put down 3.5 or 5%. So fast forward, you've now increased your value of the property, you've now paid down your balance. Depending on how much your loan or where your loan to value is at this point, you may be able to refinance and drop off that private mortgage insurance or that mortgage insurance premium. So if that happens, then usually, let's just a simple example, if the property value or if the loan amount's $400,000, your mortgage insurance on that might be $200 to $300 a month, varying, right? So you can imagine that at a time where you're able to remove that private mortgage insurance because your loan to value has decreased, you've gone from 95% or 96.5% loan to value down to, let's say, 80%. Dropping off that private mortgage insurance should be, it'll save you that amount. Once again, I always have to kind of throw the caveat out there. It depends on the rates, depends on the market, but this is generally the reason why people refinance. They are going from one set of terms that created, a certain qualifying rate and a certain term from the lender. Maybe at the time that you bought the house, your credit scores were 660. That gives you a certain interest rate, certain costs related to your loan. Fast forward a year, you've paid off some items, you've reduced the balances on your credit report. Now your credit scores are at 720. Depending on the interest rates, of course, in the market, that should offer more favorable terms for you. So when you come back and you've, made your scenario better and you look to refinance, that's the goal. You go back and you refinance at a lower loan to value, or you refinance at a time where the interest rates are better in the market. Therefore, you're able to pay off your balance and then obtain a lower interest rate, therefore lowering your monthly payment. So as far as refinancing goes, there's a lot of different, it's hard to give like an exact of this is refinancing, but the idea really is to take the current terms that you have on your loan and get more favorable terms, or get some sort of term that benefits you. So whether it's you're refinancing just to lower your interest rate because the rates have gotten better since you purchased your home or since the last time you've done a loan, and therefore you're able to lower your monthly payment, all this benefit there. Whether you're doing that or you're refinancing and dropping off the private mortgage insurance that you obtained when you first got your loan and you're saving a couple $100 there, Or if your property value has increased exponentially, you know, some areas, depending on, you know, you can do a little bit of home improvements and see your property values increase a lot. If that's the case, just a simple example, let's say that you bought the house for $300,000, and then you fast forward 2 years, the home is now worth $400,000, and you want to get $50,000 cash in hand so that you can do some sort of improvements, put money in reserves, just whatever you want to do because it's your equity. You would basically go back to a lender, go to a mortgage lender and say, hey, you know what, I currently owe, let's say 280 at this point, and you're looking to get a new loan for $350,000. They would qualify you for that new loan, check the current current property value, and give you terms based on that new scenario. And part of the requirement of your new loan would be obviously to pay off that old loan, and then this new loan would take the position as, you know, the primary or the first mortgage on the property. And first meaning not when this happened, but first meaning that the position that it shows on the title of the property. So it would be your only mortgage unless you had a second mortgage or some sort of additional lien on the property. But in that scenario, you take out the new loan for $350,000. That's going to pay off the balance of the old loan, leaving a difference. So let's say 350,000, let's do some basic numbers, 350,000 minus the 280 that you owe, that's a difference of $70,000. And then you're gonna have closing costs that come out of that. So you might have, you know, $10,000 in fees combined with your, or not necessarily fees, but fees might be 4,000 or 5,000. Then you have your prepaid taxes and insurance, prepaid interest, things like that. So maybe another 10K out of that 70K goes towards the settlement costs related to the loan transaction. And then from there, you would get the difference of the remaining balance. So if you had, you know, once again, 350 as a new loan amount, paying off a balance of 280, that gives you 70,000, subtract the roughly $10,000 in closing expenses, now you have $60,000 net at closing, or once the loan funds and records, the lender will wire you or send you a check for that balance. And then you would go on, and the following month you'd have your first payment on that new loan. As part of the closing of this new loan, they would have paid off the balance of your old loan. And that's what refinancing is. You're taking out a new loan to pay off an old loan at some terms that are going to offer some sort of benefit to you. And you ask, all right, well, if the person qualified for a home of $300,000 before, how can they take out a loan of $350,000? Well, the lender's going to re-qualify them. The lender's going to look at their income and say, okay, their income does qualify for this higher amount based on similar factors as before. What's their credit score? What's their loan to value? What's their debt to income ratio? All that. But that is what refinancing is. Another thing that a lot of people will do is when they are taking cash out, you're walking away with, let's say, that $60,000. Sometimes people might say, okay, well, I want to pay off that $10,000 credit card and this $4,000 car loan, and then I want the rest in cash, and then I'm going to go use some of that for home improvements, or maybe all of it's going to home improvements. But it truly is up to you what you want to do with the funds, because it is your equity. You're pulling it out as long as you qualify for the loan. There you go. So yeah, that is what refinancing is. There's going to be multiple benefits that can come out of refinancing. Sometimes people that don't need access to cash are just going to solely look to try to lower their payment or interest rate. Sometimes people are in a 30-year loan and then they want to start to shorten that term as they go further. So they might say, okay, you know what? We started with a 30-year loan. We've paid 3 years into it. So roughly we're at 27 years. Let's see if we can afford a payment on a 20-year term. That way, maybe their payment goes up a couple bucks or a couple $100, but now they've shaved another 7 years off their loan. Maybe they're headed towards retirement or just a goal of getting this loan paid off. So you have, change in term, you have a change in interest rate as a reason for refinance. You also have the cash out reasons for home improvements, debt consolidation, people putting money in reserves, home improvements, things like that. So like and subscribe. I hope I helped you out. If you have more direct questions or anything more specific, go ahead and send me a direct message or put a comment in there. I always check the comments and I always respond back and answer any questions. But yeah, that's just a general of what a refinance is when it comes to a home loan. And hey, if you have someone that needs to refinance, hit your boy up. I can help you out directly or have one of my loan officers help you out. So like and subscribe. I hope you have an excellent day. 100 years of wealth to you and yours. Let's have a strong finish to 2020. Good luck with everything, guys. Thank you.